For those of you that don't know, Manmohan was once the assistant chair of the IMF. He has many teaching qualifications. He's written his own books on economics. He currently manages billions of dollars in his own in a fund that he manages. He has had an illustrious career in economics and is, I would say, overqualified to be teaching an investing basics course, but he has taken the time out today to be here with us, and we are looking forward to this. Manmohan, whenever you're ready, I can begin the presentation.
Thanks so much, Arjun. Really extremely kind of you to invite me, and I'm very grateful to all the colleagues who have joined. And thank you so much for your extraordinarily kind remarks. So, you know, I was at the IMF, I was head of the financing division and head of the fiscal policy division. And currently I work on the sell side, on the buy side rather, for an investment fund, and work very closely. So the largest funds in the world, it's well over 300 billion, and work very closely with colleagues who actually do the investments. And you know, it's a real pleasure because I sort of seen the pictures I see, you know, myself four decades odd ago. And so what I want to do is to share with you the experience which I have acquired, both in terms of my own investing as well as, you know, various things which I've been doing in terms of, you know, my employment in various institutions and so on. And again, many thanks to Arjun. So what you're about to see, you know, he's played a critical role in putting this thing together. And you know, feel free if you have any questions at any time. You know, I know there's a broad range in terms of people's expertise and experience. So some of the things which I say might appear very basic. Some of the other things might appear a little bit on the complicated side. So please feel free, you know, to you know, ask questions at any time. And you know, the idea of this presentation is, you know, certainly to inform you, but also to impart a sense of joy and a sense of pleasure in investing. So with those words, Arjun, why don't you start?
Sure.
So if you go into the next slide. So what I'm going to do is essentially talk about 5 topics. You know, why invest might appear very simple and straightforward, but hopefully I'll show you 1 or 2 things which might sort of surprise you a bit. Investment goes hand in hand with risk, and there's no getting away from it. There's no investment which doesn't involve some degree of risk. Risk may be very little, but there's still some risk. And then that goes hand in hand with a notion of diversification, which simply means that you don't want to put all your eggs into one basket. And then the third is, you know, looking at, okay, so, you know, you want to invest, you are aware of risk and, you know, why you might want to diversify. Well, you know, what are the basic things to look out for to help you make money? So this is trends and sectors. Then there are 2 fundamentally different but complementary ways to investing. One which looks at fundamentals, you know, what's happening to companies, what's happening to their earnings, etc. And the other is technicals, which is what's happening to stock prices. So, you know, so this part, I'm going to be focusing, you know, almost entirely on the stocks. And then I'll end with some reflections and ruminations, which I hope you guys find interesting. So why invest? It's, you know, it's straightforward, right? But it bears repeating that you allocate your savings with the expectation of generating an income or profit from a price appreciation. And there's a huge range of assets. I've just mentioned just a few, but look, you can invest in paintings, you can invest in different types of cars, you can invest in, there really virtually an endless number of assets you can invest in. We are going to focus in this, as I mentioned, primarily on stocks, on equities, but there's a vast number of investment vehicles. Just to underline, I can't underline this enough, and I'm going to do it repeatedly. All investments carry risk. Risk and return go hand in hand. Low risk generally means low expected returns. You can put the money in the bank. That's investing. It's your saving, but you've invested it in a CD. It's virtually risk-free, not completely, but virtually risk-free. Or you can invest it in stocks. You get significantly higher return, but also substantially higher risk also. Now, there's a lot of fun in investing, and virtually everything has an exception. There, for every rule there's an exception. So it is true that higher returns are usually accompanied by higher risk, but you can have situations where you have high risk but wow, low returns. You want to avoid that. Or you can have high returns and low risk, or you can have high risk and low returns. So you want to avoid high risk and low returns. You want to go for high returns and low risk, but generally there is a continuum. As you go up, you have sort of higher returns. Risk tends to be higher. Next. So low risk, I've already mentioned. You got bank deposits, certificates of deposits, then you have bonds, and bonds, a very, very wide range of bonds. You have corporate bonds, you have government bonds. Government bonds generally, especially in a country like the US, carry much lower risk, but the returns are also very low. So if you take a 10-year treasury security, so it's a bond issued by the US government, and you are essentially lending to the US government. And, for 10 years, if you invest $100, you get less than $1 for a whole year. It's actually, you get 60 cents. So very low risk, but very low return. Stocks and stocks or equities, you're essentially becoming owner of a company. You can get much higher returns, but those returns carry substantially more risk, and they vary significantly. And then, commodities and derivatives. Derivatives, I would say at this stage, please do not touch them. It's a pretty categorical advice. They are very complicated instruments, and you can make a lot of money, but you can lose your shirt and then some also. Next. Here it's worth noting that we think in terms of stocks, in terms of price appreciation, constituting return. Historically, if you look at, say, S&P 500, one of the broadest indexes for these are the 500 largest US companies, 2/3 of the returns have come from increases in prices, which is capital gains, but a full third comes from dividends. So because you are part owner of the company, you are owner of the company, right? You share in the profits, and many companies, do distribute those profits in the form of dividends. So if you look at a total return, say at the end of a year, you have X amount return from your holdings. 2/3 of that has come from increase in price, and 1/3 from dividends. Yeah. Okay, so now this is the fun part. This is what I said that it might surprise you. So this is okay. So you have the return, you have the investment. Now, one cardinal rule is that the longer you leave the money for investing, the higher the return is going to be. But how much higher? And what sort of numbers are we talking about? So Arjun and I were sort of playing around with this. This is a website which is one of my favorite. So let's say we start with you start with just $1,000, okay? And then you put in each month rather, $100. So each year, roughly, about, 1,200 or so, but we can play around with that 100, you can lower it. But let's say, you invest it so that you want to retire, uh, say 30, 40 years time. Let's say you put in 40 years, okay? Now here it says estimate interest rate, but really what we're talking about is the return. So we're looking at price appreciation plus dividends, and let's say 15%, which is a little bit on the generous side. Historically, it's 10 to 12%. If you go back a whole century, for stocks, it's closer to 10. But let's say we put 15 there, but then you put in a range around that, and let's say you put in a range of 10 around that. So what that means is that the return might be as high as 25%. If you can have 25% annual return for 40 years, you are a financial genius and then some, right? But the numbers will be showing you also what happens the other way. If instead of 10 percentage points more, you have 10 percentage points less. So the range would be between 5 to 25. So you have the middle 15%. So let's have a look at the results and look at the table. So after, if you have put the money in, and say, starting with year zero. So after 10 years, if you had this, at 15%, believe it or not, your money, this is the power of the compounding. Your money, you're going to have $32,000 in 10 years time. If you've actually only managed to get 5% return, remember this is 1,000 initially, and you are putting in money each month. Okay, so in 10 years time, if you only got 5%, well, you got still pretty decent 17,000. But if you were getting a return of 25%, you have $65,000, 65,792. Okay, so let's now go 10 years further. So you go into year 20. Wow, these numbers begin to look a little bit unbelievable, right? So you got 172,000 as your base case, as it were, the 15%. But even if you weren't, lucky, or, luck has something to do with it, but, the decisions to make with your investment didn't pan out right, you still have roughly $44,000, okay? But look at the other side, $854,000. This is after 20 years. So you start today, you put in 1,000, and then each month you put in 100, and you really done your homework. I'll have quite a few words to say about doing your homework. And you have more than 15%, okay, here 25%, which as I said is exceptional to say the least. But nonetheless, if you could do that, you have $854,000. So if you go to year 30, uh, wow. So now, even with at 15% return, you have 800,000. 5% return, you still have 88,000, and 25% return is $10 million. And you go to year 40, and you are ready to retire. Well, let's say that you managed to get 15%, which itself is quite, it's not an easy thing. But if you could do that, then you have 3.6 million. If things haven't panned out, you still have 160,000. And if things have really panned out, extraordinary performance, and I underline extraordinary, you are talking about $127 million. So this probably is raised a lot of questions in your mind. So I hope you will share those questions with us, and I'll be very happy to go into it. But there's a very simple message there. Simple message is that persistence pays. The sooner you start saving and investing, the more you're going to have at the end. And making the right investment early on is critical. Okay, next. All right. So, one major issue is that if you invest in individual stocks, you have a lot of volatility. There's a lot of uncertainty. Even the best managed and the best stocks don't deliver. And so over many years, decades, actually, you've had a lot of investment tools, investment products, which have been designed. And one of the most important is the pooling so rather than have one individual stock, I'll talk about stocks, but it applies equally to bonds and other types of investment instruments. Rather than have one stock, let's say you pool together 100 stocks, and you can create what's called a mutual fund, or exchange traded funds. Now they are, you can look into this, you can read about them. They are related products, but they do also differ in some important ways. Mutual funds are generally more complex. ETFs, exchange traded funds, track market indices. Uh, you know, in contrast, mutual funds. So ETFs, you might say, are more sort of passive type, although you can have active involvement. So passive means that you just follow the market index, right? The mutual funds are generally actively managed. So rather than have following a particular market index, you would have a specific set of stocks which would be included. They generally have higher costs, sometimes substantially higher costs. And this is a thing to keep in mind, that if you're buying these pool products, you are really having to pay cost. And ETFs in that sense are actually very desirable, because the passive ETFs are simply following the index. The fund manager, the ETF manager is just following that. So the cost can be very low, barely maybe 1 cent, or, say 5 cents for $100 of investment. Next. And no less a person than Warren Buffett has said that, given the risks involved with individual stocks, I still think it's worth looking at individual stocks in a very serious way, and I hope all of you do. But it's also important to heed his advice that you buy these index funds, buy a good ETF, and he's apparently instructed the trustees in charge of his estate. So this is the guy, perhaps the most who's done most to emphasize value investing and buying individual stocks, doing your homework and buying the right stocks. Now saying that invest bulk of your money. Admittedly, this is, he's talking about his wife. So when he leaves this world, how would his estate be managed, right? So, at what stage in your life you're investing obviously is very, very important. But it's worth keeping in mind that buying a good ETF, diversified pool of stock, reduces significantly your risk. Returns would be also lower, but the risk return trade-off could actually be quite favorable. Next. So now looking at individual stocks then, the blue chip companies, I think most of you have heard of Dow Jones. You got 30 stocks. The thing which I want to emphasize though is that it's not a fixed set of companies. People say, well, what if I just put all my money into a blue chip stock? And my response would be, be careful that blue chip stocks also are not without risk, right? So if you go into the next, the table, right? So you got, if you look at the companies which are added, I think the important thing to note is that uh, there are companies which go back to a long time, decades. So Procter and Gamble was there in 1930, has been there since 1932. But look at the companies which have been added in recent years. So you just had Walgreens just added in 2018. Now, that means they took companies out, right? So, and the latest one is, just last month, you had companies which were regarded at one time icons, which were removed from Dow Jones because their performance was lagging for one reason or another. They may have been, excellent companies, but for one reason or another, their profitability didn't keep up, their performance didn't keep up, and they were removed. So you had ExxonMobil, Pfizer, Raytheon, were taken out, and you had Salesforce, Amgen, and Honeywell put in. Arjun asked me, maybe I should say something about which are the companies which I feel I've done well in investing, and which are the companies which have not worked out. Well, I've had several blue chip companies which have not worked out. So I think it's very important to keep in mind is that company characteristics, I'll go into those in a second. They are very important. You need to do your homework. But again, the same theme, there's always risk, and you have to be careful. Just because a company is in Dow Jones doesn't mean that it's safe. Next. I've already mentioned that the stock market as a whole. Now this is average going back a century. It's a 10% return, but all of you know that average doesn't mean that you have the same or even similar. So you've had times when you had very significant returns which have been significantly weaker, and other times they've been significantly higher. Over time, of course, market has continued to go up, and that's that's why we are discussing, investing in the stock market. Next. So now, okay, so say that you want to invest in whether it's an ETF or an individual stock. What are the things to look out for? So I've called this which companies, but companies could be, you could have a pooled ETF, ETF which looks at some subset of technology, let's say cloud computing or robotics or something, right? And the point I want to make with this slide is it's very, very, very important, underline very, to have a sort of good understanding of what are the big trends going on around you. Investing is absolutely fascinating, really interesting, because it's everything around you. So what are the big trends which would have a bearing on how well companies, how well sectors perform, and then have a huge bearing on your returns? right? So is your return going to be closer to the 5% or 15%, or wow, even higher, right? So I think all of you would have your sort of own assessment and your own sort of favorite sectors where you think things are really moving and looking ahead. But this is just a small selection which I put up here, that the technology, to say that we have a technology revolution going on, it's probably an understatement, right? And it was happening even before the pandemic, before COVID. But what has happened with the pandemic is a huge acceleration. And I saw some analysts say that what might have taken 5 to 10 years to transpire, let's say, working from home, or telemedicine, or telefinance. And of course, you've got internet shopping, right? I mean, all these trends were there, but what might have taken 5 to 10 years has actually happened in 5 months. And this trend is not stopping. It's going to continue even when we have a vaccine and pandemic is under control and so on. You're going to have technology. We are, according to some, we've only seen still less than maybe 20% or 10% of this revolution come to pass, the technology revolution. Demographics, what does that mean? Just means pure and simple, people are getting older. People are getting older. Average age, in Europe, US less so, but even here and in many countries in China is increasing. So all that goes with it. Healthcare issues, for elderly people are becoming much more important. People would, to have a sort of driverless car, there'll be a huge boom as the populations are aging. So, these mega trends have a huge bearing on what the potential returns could be. Another area which is extremely important and becoming so more so by the day is climate change and ESG, more broadly, which is environment, social, and governance issues. A fourth one, which again has been a trend underway, but has come, to the surface, is deglobalization. So whereas you had, Apple producing, without any hesitation, all its cell phones in China, right? So globalization, the market is in the US, you are producing it in China, selling a lot in China also, but bringing it here. There's going to be, for a variety of reasons, and again, that had started happening before COVID, but COVID has accelerated that process. Maybe you want to build the plant at home. Well, part of the reason you were doing it overseas was because it was a lot cheaper. Labor costs were a lot lower in China. Well, labor costs have gone up quite a bit. And conversely, now you can have robots. So you can set up a factory in the US, which will produce those cell phones, right? Maybe at a similar cost as producing them in China. And given the concerns about disruptions to, global supply chains and so on, this is a trend which has a huge bearing on many sectors, including transportation and so on, which is worth paying attention to. Look, I will stop here. I have about half still more to go, or under half, but I see there are quite a few questions. So how should I proceed, Arjun?
Sure. I can ask you the questions in the order they came in, and then as you answer them, we'll move to the next one.
Sure, sure.
So the first one is from Amreen.
Mm-hmm.
Um, this might be a question with no real answer, but understanding now that keeping investments for long periods of time will most likely lead to some great return, why do you think investing isn't more common?
It's a good question. It's a good question. Remember what investing is, right? You are investing what you're not consuming today, right? And consumption is fun. You want to go out and spend the money, right? And why worry about 10 years or 20 years from now or 30 years from now? Say, well, I have $1,000. I'd rather go and buy nice pair of shoes, nice clothes, and so on. And for sure do that, right? But leave aside a little bit for investing. So I think it's partly it's that, partly it's a question, investing is not that easy. um, People, it takes time and effort and so on. So there could be a whole range of reasons, personal reasons. Is the person make having, does the person, does she or he have enough income that they can in a sense satisfy their basic needs and then still put aside. On that, actually, I would say that, you know, I have seen people who you wouldn't think be able to save and invest, and yet they do so. And I've seen people on the other side, at the other end of the spectrum, you would think they would be saving and investing a huge amount, and they don't do so. So there's also sort of personal preferences. But as that table and that chart, Arjun showed, I think it really, really is worth investing, and it pays to start sooner rather than later. So if there's one lesson I want all of you to take away, is whether you are 20 or 22 or 24, start investing.
All right, Manmohan uncle, I'm going to pair a couple of questions together because they're
Sure,
all on the same lines.
sure.
How do you evaluate an ETF to determine if it's a good investment? And could you tell us some indicators of what good beginner portfolio ETFs might be?
Um, so I wouldn't want to go into sort of specific portfolios, except good ETFs, except to say that if you have the broadest uh, um, pooled set of stocks. So let's say, this SPY, which is essentially an ETF which mimics S&P 500. That would be something you could look into. Or triple QQQ, which is for NASDAQ. And if you look at it, I think we may even actually have a chart on this, Arjun, later.
Mm-hmm.
Right? That has done really well. So I would start with that. There's a lot of literature. You just Google, and of course, don't always believe what you read on Google, um, uh, or I would go so far as to say maybe disbelieve most of what you read there. But you do get some quite good literature. Um, you can have a lot of technology oriented ETFs, and there's some really good ones. I wouldn't hesitate to look at the performance of those. But one very important point I'll come to later is past is not necessarily a guide to the future. So just because an ETF or a stock has yielded very high returns in the past, please, please, please don't think it will continue like that. What you want to do is to look at the fundamentals. So look at these sectors, the ETF in technology, but is it an area within technology which you expect to be doing well? Or is it an area which is already become commoditized, as it were? If you're looking at healthcare ETF, is it something which is likely to be something, which would be broadening and deepening, or is it already behind us? Similarly, climate change and so on. So two broad sets of ETFs. I would personally, go with something like, NASDAQ, sort of triple Q, but the timing is very important. I'll have quite a few words to say about that. So that I won't go any deeper into that, into this than that.
All right, and the last question for this half. Do you have any thoughts on what sectors may be more resilient to the pandemic? For example, the restaurant sector certainly doesn't seem to be.
Again, that's a good question. I mean, we've seen that restaurant sector isn't, airlines aren't, hotels are not. And what you have seen is the sector which, within technology, which allows you to work from home. So I'm sure some of you have seen what's been happening to prices of stocks which cater for that, or internet shopping like Amazon, right? I mean, it's done really, really well. So in the pandemic, think, okay, what does the pandemic entail, right? So pandemic entails that, even when it's, things are sorted out, you might get another pandemic a year from or two from now. The world has changed, is changing. So, things which allow you to work from home, things which allow you to have entertainment at home rather than going to the cinemas, things which allow you to have, there's a telemedicine or tele-education. I would say those sectors in general are likely to do well, even in a pandemic. But I would also say healthcare, the vaccines and so on. I think some of the companies which are, doing research or at the forefront of that, sectors where those companies are in general doing well, climate change. But there are obviously many other sectors which have been hit hard and it'll take quite a long time to recover.
Perfect. Now we can continue with the presentations, and then we'll do another round of questions at the end.
Sure. So here, let me just get rid of this thing here. Okay. So, if whether it's individual stock or you're looking at a sector ETF or a mutual fund, you're looking at the company. So what are the key characteristics? There are many, but I think one of the most important is that, you want to have a company which is well managed. And well managed doesn't necessarily mean, although it is usually the case, that the company's profitability is high. It's reflected in other various indicators, which I'll come to in a second. But it could be that it's been hit by a shock. Shock just means that sector is turned down. Has had a well, take the pandemic itself, right? So the company's performance might be affected adversely. But if the company is well managed, it will come out of it well. And in fact, it gives you an opportunity. The company is well managed. Let's say, if I just quickly go through the other elements in this, it's well recognized brand. You got a Coca-Cola or any of the sort of brands you see in your kitchen or at home. You would recognize the brand, anywhere. It's worth thinking seriously about that. Well-managed company with a well-recognized brand is likely to be resilient. There are other characteristics like, to what extent are you likely to have you have to be careful that many companies which have done exceptionally well pay actually very little dividend. So Amazon, there's no dividend, right? It's a growth company. And so, that ratio, that statistic I gave you, that 1/3 of the return comes from dividends, 2/3 from price appreciation. That's that's the average, right? But there's some companies where you get no dividend, but they're growing, gangbusters, and it's worth looking at them. And then, of course, valuation. I'll go into that in a second. You obviously want to be careful not to buy a company which is costing more than is warranted by its fundamentals, by its economic and financial fundamentals. Next. And that brings me to a major setup. There are two major ways of, or two very different ways of looking at whether it's individual stock or pooled assets. One is called the fundamental analysis. The other is technical analysis. Now, the fundamental analysis is straightforward. I think all of you would understand it immediately. If you're looking at a particular stock or stocks, it's the intrinsic value of the stock, the financial operating strength of the company, what industry it is in, what's happening in the economy, etc. Right? And the key elements are, how much, what are the revenues, what are the profits, what are its expenses, what are its asset liabilities, and so on. And based on that, I mean, there's a humongous number of people involved in doing this analysis. You have the stock analysts in all the major investment banks, throughout the financial sector, whose job it is to look at these fundamentals, right? Um, Technical analysis, on the other hand, might appear a bit sort of strange to some of you. It says that, yes, fundamentals are okay, that's fine, but all the fundamentals information is reflected in the stock's price and how the stock is trading in terms of the volume, if there's a big demand or if there's not enough demand, the demand is very volatile. You look at that. And the technical analysis, there's a huge amount of work which has gone into this. I remember, 20, 30 years ago, technical analysis was not perhaps given as much attention as it has been since then and as it is now. I think it's actually very important. And one of the major reasons is that a lot of people do use technical analysis. Its assumption is that everything is reflected in price. And so you don't need to pay attention to the fundamentals per se, because it's all reflected in the price. And you look at charts, how are the prices moving, how volatile they are. You look at moving averages, how have prices done over the last 50 days or 100 days, etc. And what I find actually very useful is to look at both. You have people who sort of dismiss one or the other. Mostly, I think people who do fundamental analysis dismiss technical analysis. I think that's a mistake. I think there's a lot of very useful information in technical analysis. Next. So this, I wouldn't spend too much time. There's a broad range of elements of fundamental analysis, price to earnings ratio, which is, what is the value of the stock as it's trading now compared to company's earnings, compared to its profits, right? Now, high PE ratio could mean that the stock price is expensive relative to earnings, and possibly overvalued. Um, and low price earnings ratio might mean that it's cheap relative to earnings. But as with all these ratios, you have to be very careful. Um, Earnings are based either on the past or forward analysis, predictions regarding the future. And I'll have a word to say about the predictions. But it's, past is not necessarily a guide to the future, and future is unknown. So one has to be very careful. That's one. Second is P. So in other words, just because a company has a low P ratio doesn't necessarily mean it's an attractive buy. Be very careful. It doesn't factor in earnings growth. So it's looking at level of earnings, but not the rate at which they would be growing. And then very importantly, the P ratios differ significantly across industries. So you've got some industries, let's say vehicles, P ratio might be sort of, average might be 8 or 10. Financial sector, say banks, P ratio might be 10, 12 average. But you might have in some of the technology sectors, P ratios would be significantly higher, hugely higher. But it doesn't necessarily mean that the stock is overvalued. Depending on the characteristics of operations in that particular industry or sector, PE ratios can vary a lot. I always pay some attention to it, but not preponderant attention. It's worth looking at, on a regular basis, and it is an important indicator, but it has to be seen, it must be seen in conjunction with many other indicators. So Arjun, let's quickly go through the next 3 or 4 slides. So one is a complementary indicator is price to book ratio. So it's, valuation, current market valuation relative to the net value of the company. So assets minus liabilities. Its book value provides a measure of company's intrinsic worth. And if you have a price to book value around 1, that's telling you that company's capitalization, stock price is, so broadly reflecting what the company is worth intrinsically. If it is significantly less than 1, this could be interesting. You have to see, well, why is the market value now so much below stated book value? There could be a very significant opportunity there, but there could be a wide variety of reasons why it is that. But it's a very useful indicator in conjunction with price earnings ratio. Next. Then you've got debt to equity ratios. Too much debt is risky if earnings or cash flow are volatile. And again, like a PE ratio, it varies very significantly from industry to industry. Next. Free cash flow, it's a useful indicator, and you have a significant amount of free cash flow. It precedes increased earnings, and of course, free cash flow is reflected oftentimes in share buybacks. In recent years, you've seen share buybacks play a very important role, as well as in dividends. Next. This is price earnings to growth. So taking into account what's happening to growth of earnings, not just the level. Next. So this is, so we are going to look at some of the sort of broad, elements of what to look out for and what to avoid and so on. So, you have 2 types of, um, investor, let's say, sentiment. So one is that, my God, the stock is going up, this ETF is increasing in price, so fear of missing out. And the other is, you didn't go in and the stock has fallen, 10% or 20%, or ETF is now down 15%, and the joy of missing out. And both these are are elements, which I think any investor, I think if she or he was being honest, would say that they experience. And depends on your degree of risk tolerance. That, if you, my strong advice would be to be towards the sort of spectrum of, minimizing risk, taking especially at your, early stages of investing. And so maybe it's better to miss out rather than go in. So you have a joy of that you didn't go in and the stock fell 15%, rather than, or say, okay, had I gone in, or it would have gone up another 10%. Next. Maybe we'll skip this. We can, if you want to, Arjun, can you show, so put in 2 or 3 stocks,
Sure.
G, Apple, and also put in the indexes, Triple Q and SPY, the ETFs. And then put in GE. and then have a five-year horizon. Just click on that. Perfect. Uh, right. So you can see that, over a 5-year period, so this is a performance in percentage terms that you've had Apple stock as up despite the recent quite significant correction, 346%. Okay, but you see quite a bit of volatility. I mean, the last, in 2020, of course, there's been a very significant run up in the stock and it's come down. Um, uh, then you look at a GE, which at one time was regarded as the most well-managed company in the United States, or certainly in the industrial sector, right? That stock is down 75% over a 5-year period. Okay, so in terms of our what we were looking at, so Apple would have yielded much more than 25% return a year. Okay, over a 5-year period, compounded 25% will probably be it will be substantially less than what it has actually yielded. But on the other hand, G stock, you would have lost your shirt and then some, right? You're down 75%. If you were risk averse, which I strongly advocate, at least part of that 1,000 you invest in a diversified broad ETF, and let's say you had put the money into triple Q, actually you would have done very well even with that, right? You're up 175%. And even with SPY, which is S&P 500, it's nothing to be laughed at, given that, if that money had been left in the bank, you would have been earning, 0.5%, if that, over a 5-year period, or 1%. I mean, rates have really come down now. So, I mean, this is just to illustrate that the very significant variation, even in indexes, right? And certainly in individual stocks, you're talking about, different universes. Next. Okay. So I mentioned, going back to the risk aspect, um, one has to be very humble when you are investing. And I thought it would be of interest to you to highlight what happened to this long-term capital management fund. It was a hedge fund which used absolute return trading strategies. It just means it tried to maximize the returns. And it was founded by no less than a former vice chairman and head of bond trading and one of the most illustrious investment banks. And the board had 2 Nobel Prize winners. And the reason I put there, what they won their Nobel Prize, it wasn't just that they were economists, but they won their Nobel Prize for their contribution to finance. And it was a new method to determine the value of derivatives. And from 94 to 97, it was hugely successful. It actually made, I think, an average of 35% a year. Okay, 94, 95, 96, 97. And then in 1998, it lost a humongous amount, literally, billions in just a few months due to high leverage, leverage to borrowed money to invest and exposure to the 1997 Asian financial crisis and then 1998 Russian financial crisis. During that time, actually, I was on leave from the IMF and I was working at Credit Suisse investment bank in London. And I saw at firsthand the humongous amount of uncertainty and volatility which the Asian crisis and the Russian crisis led to. And this fund set up and managed by some of the most experienced people in the industry just collapsed because of the huge losses. And the moral of the story is be humble. Next. Um, there are a few generalities which I thought I'd just quickly look at. There is some truth, some substance in that, and it's worth paying attention. But like all rules and generalities, one has to use a lot of common sense and be careful. Do markets return to the mean over time? I think that's an important thing to keep in mind in terms of broad market evolution or developments. Individual stocks, as I gave the example, showed you the GE, may not return to mean, may never return to mean. But markets, they might be in a euphoric mood, but then they'll come down, or they might be treading water or actually going lower, and they will turn up in general. And the others, excess leads to the opposite success. You got periods of euphoria followed by periods of extreme pessimism. And so 2 and 3 are, I think, is worth keeping in mind. And you want to avoid both. Don't get caught up in euphoria, and you can get some really good opportunities when everybody is being very pessimistic. Then you have, market corrections don't go sideways. You get a lot of lessons which are sort of derived from the experience, and I think there's some truth in that. Number 5, I already indicated that people generally see, oh gosh, this stock has now gone up 30% or 50%, or this ETF has gone up, 15%. So they jump in, and that's just when the thing is beginning to turn. And that's worth keeping in mind. Very, very, very important. Then I think fear and greed, that's evident. Market strong when broad. What that just means is that you have a lot of the stocks increasing, right? There's strength in the market. If you have if a few stocks going up, be very careful. And then the last one is my favorite actually in this list. You'll be amazed how even very experienced investors get taken in by the so-called experts and forecasts. Please be very careful. Experts and their forecasts are useful, they're very helpful, they're worth taking into account, and sometimes they can be invaluable, but common sense before everything else. Next. Yeah, so is stock market gambling? Is it just luck? No, but you can gamble, please don't. You can't time the market. That's generally true, but as I showed, in one of the charts, and I mean, if you had invested in late 1999, when the stock market, because of the technology stocks, they were at peak. In the subsequent 2 years, the market fell almost 70%, and it would have taken you 12 to 14 years to go back to that level. So don't tell me that timing doesn't matter. Timing matters enormously. You can't time the market precisely, today or this week, but in broad terms, you can, and it's really, really important. Market is always right? No, but a lot of the time you have to be very respectful of what the market is telling you. There's a lot of information there which needs to be taken into account. Next. Okay, a few words of wisdom. Yogi Bear are one of my favorite. So I've already alluded to forecasting the future. So he says it's tough to make predictions, especially about the future. That's straightforward. You can observe a lot by just watching. So just see what's going on. What's happening to consumer demand. What's happening in various industries. What's happening around you. And you'll be surprised how much information you can get. Is there a particular product which is in increasing demand? Why are people, demanding it? And you'll be amazed how much information just watching closely what's going on around you gives you with regard to your own investing. Future ain't what it used to be. It's a lot of uncertainty. Things are changing every day. Who would have thought that Tesla would come up? Who would have thought 15 years ago that Amazon would be where it is, or even Apple would be where it is? And then the last one is is also very good. If you don't know where you're going, you're going to end up someplace else. So in other words, have a plan, be careful, uh, have a strategy, and that will stand you in good state. Otherwise, it's going to be even more challenging than it is. Next. This is a summary of what I've already indicated. In good times, be very careful. Euphoria is contagious. You want to be very, very, very cautious. Um, on the other hand, when things are looking bad, you can find some real opportunities. And then the third is buy and hold works. We've seen that, but only if you are in the right place. And if you're not in the right place, it's better to get out sooner rather than later. Next. Yeah, a couple of other quotes. They are ascribed to one of the greatest economists, I would say the greatest economist, John Maynard Keynes. Now, whether or not he said those, it's some people dispute it, but they are wonderful quotes. One is, facts change, I change my mind. What do you do? So what that is saying is that you undertook your investment based on some analysis, hopefully a lot of analysis, based on your understanding of where things were, based on certain sets of facts. But things have changed. Maybe government policies change. Maybe new industry has come up or new companies have come up. And that has a big bearing on your investment. Don't hesitate to re-examine the premise under which you made your investment. Um, and then the second one, market can remain irrational longer than you can remain solvent. So what that means is, please do not go with leverage. Do not borrow money and invest. Invest, especially in stocks, money which you think, gosh, what happens, God forbid, if I lose a substantial part of it. Or, it declines in value and remains low for a while, for quite a while. So please keep that in mind. Next. Just to elaborate on that, markets are not always rational, far from it. Mispricing, market is pricing a stock far, far more than its intrinsic worth. Happens all the time. There's a herd behavior, and the comment, avoid stocks that are overvalued, go for undervalued. Sounds easy, but you'll be amazed how many investors don't heed that. Uh, uh, so to, in a sense, take care of that, look at a wide range of financial ratios, indicators, a wide set of factors. Next. And this is my, my effort at summarizing all the things I've said and many other things which I haven't said for successful investing. So start off with humility, be humble. So, it's really saying that a lot of unexpected things can happen. Don't think you know everything, even if you even if you know most of things. There are a lot of factors affecting a company, or if you have a pooled asset, uh, have a sense of humility. Inquisitiveness, I've talked about. Be on the lookout. What's happening, why is it happening, what's happening here, what's happening in Europe, or what's happening in China. Inquisitiveness in general is invaluable in life. In stock investing, I think it's indispensable. And the global view is a sort of catch-all, which means, look at policy. So, if the Federal Reserve here is saying that interest rates are going to be kept close to zero, wow, that's very important. That means that, more and more people are going to say, well, why should I keep my money in the bank? So they're going to go into the stock market. So that's going to have a positive impact on stock prices. So, the global view, what's happening in China, the implications of that for globalization, I talked about. What's happening not just in the sector where you are looking at for investment, but in other sectors. And then I'm afraid there's no alternative to hard work. You have to, if you're going to invest in individual stocks or even ETF, you have to do your homework. Um, it requires focus, it requires time, it requires effort, but it sure pays off huge, big time. Um, and then you have entry exit. I've already talked about the entry part, that, to say that, it doesn't matter when you go in. Yes, there is a school of thought that you do dollar budgeting. And I think there is something in that. If you have 1,000, don't put a whole 1,000 in one go. Put 100 this month and another 100 next month, 100 after that. So let's say between this month and the end of the year, you got the US elections and the market goes down. Well, okay, you haven't put the entire 1,000 there, right? Um, and there is a lot to be said for that. But in general, if you are in an environment where the market is clearly overvalued, or stock is clearly overvalued, and yet people are still going in, eschew that, don't go in. Alternatively, I haven't said much about exit, which is a very important element of investing, very important. If you made an investment, things haven't panned out, and you are losing money, you must have a stop loss. And you say, I'm going to get out, I've lost now already 5%. There's always this feeling, yeah, if I if I stay, maybe the stock will go up. Trust me, resist that feeling, right? If it's gone down 5%, it could go down 15, 25, 35. The company may be worthless. So exit strategy is very important. And then, if you have these things, you manage the risk, returns can be phenomenal, phenomenal. You saw some of the numbers. If you start off not with 1,000, but with 5,000, you're talking about orders of magnitude larger. And, by the time you sort of think you are ready to put up your feet, you will be very, very rich. So I'll stop there.
All right, we have some questions coming in if you're ready for them.
Sure.
Awesome. First question, do you have any advice on option trading?
Yes, it can be a useful complement, but I would approach that with a significant amount of caution. It's like,
For a lot of us might not know what option trading is. If you could just do a quick 1 minute run through of option trading.
yeah, so sure. So, you have you have two types of options mainly, right? You have call options and you have put options. And a call option is in a sense, you're buying the right to buy a stock at a given price, okay? And so what does that mean? That means that if you think that the stock is currently undervalued by the market, right? And it's likely to go up in price a lot, right? The cost of buying that right might be quite low. Okay, you buy that call option, and when you reach that, is the strike price. It's quite complicated. I mean, I can talk individually afterwards. You can make a lot of money. And similarly, the put option is the right to be able to sell some commodity at a given price. So if you can buy a right to, um, let's say that if you think oil uh, uh, or particular stock, actually, that's not going to commodities. If you think that a particular stock is going to, fall in price a lot, uh, but the actual fall is even greater, right? So you've given you what you've done is you bought the right to sell that stock at a particular price, which will bring you a huge benefit. So it's quite a complicated instrument. I would not advise, if you are essentially starting on in your investment, in a sense, career. It's certainly worth reading up, looking at, but I frankly would not advise going into it.
Okay, the next question is, what would be an ideal percentage of your income to set aside for investment?
Um, that's a difficult one, right? I mean, it depends on your individual circumstances. So I would say it's difficult to say there is an ideal. Uh, you know, Remember, it depends quite a bit also on your level of income, right? If you, let's say, if you are earning 50,000 versus earning 500,000, right? Um, Obviously it's going to be very different percentage, which would be ideal. In the first case, maybe, you have to satisfy, as I said, all your other needs, consumption, and so on. Maybe the percentage may not be, it may not be possible to have a high percentage. In the second case, maybe you can have a very high percentage. So I won't put a number on it, but I would say that if you have to, let's say, forego a spending at the margin and to save and to invest, do that.
Perfect. How do stocks perform during periods of high inflation?
That's a very good question. It depends on what type of stock you're talking about. So in the most recent period, you've had inflation very, very low, and there's been an expectation, though, that inflation might increase. So you've had gold stocks shooting up as a hedge against inflation, right? In general, when you have inflation, the nominal value of the stocks goes up, right? Because you have inflation, generalized inflation, prices are going up. So companies, products are selling at higher prices. That's prices are going up, and so the nominal value of their earnings is going up. So in nominal terms, stocks will do well. And actually, this is a very important general statement, that bonds, which are fixed, fixed income, we call bonds the fixed income asset, they go down in value. And obviously, in a period of inflation, so let's say you take $1,000, right? And you got a 10% inflation, and that money is lying in the bank. Well, in very general terms, at the end of the year, that money, that $1,000, is worth 10% less, right? Now, inflation is nowhere near 10%. It's not going to be 10% for a very, very long time, if ever, actually. But there have been periods, not even that long ago, during the 1970s, you had inflation well over 10%, even in the US. And you've had, of course, inflation rates much higher in other countries. But even a 5% inflation or a 3% inflation, right? You got money In a bank account or in bonds, well, it's losing value in real terms. Whereas with stocks in general, you would have an increase in the nominal value, and to what extent that overcomes what's happening to the general level of prices, which is inflation, depends on what sector you are in, what sort of companies you are in, and so on.
All right. The next one we have is it okay to buy penny stocks or new IPOs?
Um, so the reasoning behind buying penny stocks is that the stock is it costs very the price of a particular of a stock is low, right? And therefore there's a sort of implicit notion that this must be valuable, it must be attractive. That ain't so, right? I mean, just because the price is low doesn't mean that the stock is undervalued. It depends on these things which I was mentioning. What are the earnings prospects? How are the earnings likely to grow? What are the assets of the company relative to its market capitalization? So I would say that penny stocks per se, I would be, I don't think one can generalize at all. You could have maybe some penny stocks which may actually be quite attractive opportunities. Other penny stocks, I would not touch them.
And what about new IPOs?
New IPOs also, what you generally have is, uh, institutions, which are behind bringing a company, banks and so on. They usually sort of hype up and then they underprice the initial listing price, and so you get, prices going through the roof initially, and then you got a very significant correction. And sometimes that correction remains. Other times, you get a significant rebound. So again, it's very difficult to generalize. You have to look at the fundamentals and see, is the company which is, IPO is coming up, is it being priced fairly? Askew herd mentality. If everybody is buying this, doesn't necessarily mean it's the right thing to do. So the company comes in, the IPO is 50 and it shoots up to 80. Should you go in? Depends, right? It may be that from 80, it will go back down to 40, or, it'll go down to 40 or 30. Or it might be that, it was underpriced very significantly, and the sector it's in, the environment it's in, given the company's management, which is brilliant, stellar, it goes from 80 to 160 in a year or two, or even less, right? So again, you know, the second H, hard work, right?
Yep.
It's worth it. It's worth it, guys. It pays off, and it can be a lot of fun. I know most of what I've said may not appear fun, but it can be a lot of fun. It's an absolutely wonderful thing to do, but be very careful of generalities. Whether it is IPO or whether it's penny stocks, you can make a lot of money, but trust me, you can lose your shirt and a lot more besides.
So the next one we have here is, how long should one hold on to their stocks or bonds? And how do you tell when it's the best time to sell or buy?
Uh, uh, these are all very good, interesting questions and not easy answers. Uh,
Manmohan, if there's some that you think would require more elaborate responses, we can save them and just send out the answers later if that's what you're more comfortable with.
yeah, or we can have a sort of bilateral discussion. Um, Look, I mean, it depends on, individual circumstances. It depends very, very much on how you view that particular stock or that particular investment. So I've had, for instance, Apple stock. I bought it. It was one of my good investments, actually very good investment. So, the stock was split, as you know. It was trading around sort of 120 or so. It sort of come down quite a bit, 20 odd percent. But I bought it when it was the equivalent of $4. Okay, and that was over 15 years ago, and I just kept it. It's a great stock, it's a great company, I believe in it. And from time to time you have people saying, well, it's way overvalued. Yeah, but it's diversifying, it's doing a lot of things, management is stellar, the product is iconic, so I don't expect to be selling it, right? Other stocks I've bought. I have bought GE. I had sold some of it, quite a bit of it. So it depends on, one can't have a sort of hard and fast rule. What I would do, what I would emphasize though, and that is a very important rule, is do not panic. If stock is going down because the market is going down, that's also very important consideration. Is the stock going down simply because investor psychology has now become very negative, very bearish? So everything is being sold. So don't sell. Why would you want to sell? Right? Just hold on. I give you an example. So I was at the IMF in 2008, 9, when the global financial crisis happened. And one of my deputies in early 2009, so the stock prices fell like 40%, from September, August, September 2008, in the following 4 or 5 months. And very smart guy, very, very smart guy, but he had money in 401k, his wife had money in 401k, and he sold the entire lot because he panicked, he worried. Hey, markets have gone down 30%, 40%. The individual stocks I have gone down even more, and this is the end of the world. And of course, that was a huge mistake. It was a huge mistake, right? So one has to be very careful. Again, go back to the example I was giving of, the tech bubble at the end of 1990s. If you had by mistake gone in at, when, Nasdaq was at its peak, and the stock started falling, 5-10%. Well, cut your losses and get out, right? But it depends on individual circumstances. If you had said, okay, well, I'm going to stick in here for the long run, okay, that's fine. But then it would have had to be a real long run, in the sense that you would have had to stay in for 14 years before you broke or even. But then in the next 6 years, you would have made up for it. That's for sure, right? And you might say, yeah, but if I sort of gotten out then, I may not have been able to get back in. Uh, it's also true. But, it depends on the circumstances. That's where also, judgment comes in. And you combine that with hard work.
So we have a few more questions, and if we don't get to all the questions today, don't worry, we'll have Manmohan answer them, and we'll send you all the answers. But the next one we have here is, would you advise putting stop calls on index fund purchases or just on individual stocks?
I would say you can do that on index fund purchases also, for sure. Why not? And depends on your risk tolerance, depends on your circumstances. If you have some individual sector ETFs, right? And you would be very uncomfortable if you had a loss of more than 10% or so. But the environment is very volatile. Look, we are going into extremely uncertain, uncharted territory with the US presidential election coming up in a month and a half's time, right? You get a huge volatility. And if you think that, you're not going to be, happy, you're not going to be able to sleep at night. The ETF you have has lost, 25%. Think in terms of a stop loss. But as I said, be also careful that, maybe you would have a sort of sharp collapse, and then the thing will rebound very, very significantly, very quickly. In general, if you've chosen your index fund, your ETF or mutual fund carefully, then I think, because it's already a pooled product, the risk is already significantly or substantially lower. Maybe you can ride it out more than perhaps in the case of the individual stock. But again, I want to emphasize, I mean, this one has to be very careful not to generalize.
Manmohan uncle, thank you so very much for your time.
Not at
I
all.
know I learned a lot. I hope everyone on the call also learned a lot. And we really appreciate you doing the Seva for us. And we look forward to every other iteration of the series with all the rest of the Singh investors. But thank you for kicking this off for us.
Not at all. It's been an absolute pleasure. Thank you so much for inviting me. And yes, I have 4 other colleagues. We formed a company, which is Singh Investors. And thanks to Arjun, we have this wonderful logo on the right-hand side of the screen you can see. And so my colleagues will be coming in and going into much more detail. I've tried to give you a sort of broad overview, broad perspective on do's and don'ts of investing. They will be able to go into much more technical details and so on. And some of the questions, which you've had here, you could also broach with them. And I would love for, any of you who has, question, through Arjun, let me know. And also, if you guys would like to be involved with Singvestors, and it's a company which we just set up. It's in the process of we are in the process of developing it, and we would be more than happy to discuss with you on how you might be involved in it.
Thank you, everyone, for coming out today. And we look forward to seeing you at the next event in the series.
Thank you so much, guys. Thank you for your wonderful questions, and thank you for attending. It's been a pleasure.
Bye, everybody.
Bye-bye.